for admitting guests. Awesome. All right, let's start then. Hello, everyone. Welcome to the House of Pitch Investors Talk. We are today with Rishi Sharma and Melinda B. Melinda is a scout for several VCs and also founder of a startup. And Rishi is a venture capitalist. And we talk about early stage metrics today. That's the tricky question for early stage founders, because when they start the companies, they read all the tweeters from VCs and all the advice. They can hear that venture capitalists or angel investors usually invest in founders. On the earliest stages, they look for certain characteristics in the idea, but mostly in their character traits, like if the founder is well positioned to succeed. But when you try to pitch those investors, they start asking for metrics. So today's conversation to find out what metrics are we talking about when we consider early stage. And my first question will be, the early stage startups is a wide variety actually of different stages, from like pre-product, sometimes even like pre-idea, to the MVP, then to pre-seed and seed stage. And all investors consider the early stage with their own perception. So my first questions to Rishi, like, what is early stage to you? And how you divide other like sub stages in this early stage, and what is the difference, and what is the crucial metric that allow a startup to jump from one subsection to another, from like idea to MVP and earlier forward?
Yeah. So yeah, like you mentioned, like as more dollars are coming into venture, it's getting more stratified over time. And so as a result, people, whether you're an emerging manager or you are an established fund, there tends to be more coming earlier and earlier in order to get the returns appropriately. And so you're now seeing even funds that are starting what they call inception, which is even before pre-seed. So it's just at the time of the idea. And so I think this is just like a continual breakdown in terms of just like the dollar value. That seems to be where a lot of people are kind of doing, is the amount of money you're raising and then what valuation is one way that people are kind of stratifying it in the easiest way. So I would say like essentially below $1 million raise, you're generally going to be a pre-seed. And then that could stratify both the angel round or an inception round now. So below $1 million, I'd say like it's pre-seed till idea. And then post $1 million, you're looking at kind of like $1 million to $5 million is generally what you're going to consider a seed. There may be some seed extensions at a higher evaluation and higher raising amount, but generally that's the rule of thumb. And then in terms of metrics that depending on the type of revenue model that you're going, but let's just take, for example, SaaS as like the most common business model that people are raising. It tends to be, you're looking for large amounts of growth plus 50% growth month over month, so some sort of traction moving in a particular direction, and a gross margin that's healthy and capable of scaling. So I would say like north 65 is what you're really looking for. And that's just like a rule of thumb in terms of SaaS. Now you can take into account marketplace or other types of revenue models, and they may be different, but like on most basic metrics to look at, that's what I would recommend.
So let's say we talk SaaS. and there is an MVP, and the founder comes with several LOIs from companies you like probably know, but not like the major brands on the market. Would you consider it a metric? Like when you say the traction, what kind of traction do you expect when the startup is like 6 months of operation or like up to a year?
Yeah, I mean, in that case, we're probably just looking for like market validation to some degree. Right? They're 6 months in, so they're either having paid, luckily, hopefully they have a paid pilot, so we have some sort of cohort analysis that we can run against the 6 months of data relative to what that looks like. But if it's, free pilots, then that's fine, as long as we can just like, we really just want to understand the company and how sticky the business is based on the users that are using the platform. So it's a lot more product based, as opposed to kind of revenue based in that context. And then, like you mentioned before, we're also looking at the team. Like, how are they solving the problem? Is this a personal problem for this, or is this kind of coming from an outsider perspective? Domain expertise, advisory board associated, market size. So we're taking into account all of these things. When you have way more on those additional things, when we don't have as much data about the product and or revenue traction. So
Thank you. Melinda, what is your take on this question? Like, what is early stage for you and how you consider startups? Like, what are you looking at? Metrics
Sure.
or character?
Yeah. I'm Melinda Chu. I went to Princeton and I'm a doctor and researcher and also have my own startup in the biotech and med device areas, but also on the other hand, I'm a VC scout, as she mentioned, for a few firms, which are tech-enabled firms and more generalists. So, and they're early stage, Level Up, Expert Dojo, like Allied Venture Partners, a number of them. And so hopefully, when I meet with startups, like it will fit one of the thesis of those. And then, of course, through events like this and other ways, I also meet different investors and stuff. And since, from the founder perspective, I also try to be helpful, even if in terms of the scout role, it's not a match for the startup. I think it's really tough. And yeah, he was talking about SaaS, and that can be kind of a little bit more straightforward, or like consumer tech, in terms, of course, like things have changed, as you guys have probably heard, over the last couple of years or 6 or 12 months, where that investors are expecting like further milestones than like in 2021 or 2022. So that's challenging for founders. Definitely, I think momentum and traction, like on the upswing, is really important. I mean, of course, you want to have like thousands of, if you're a consumer, thousands of users and like starting to monetize and stuff. But if you can show, growth, like he was giving, like, 50% like growth month over month, or, definitely positioning like what you're working on as, yeah, like as forward moving and having traction rather than appearing static is helpful. I mean, like I've heard different things. I think another important thing is, whereas like a couple years ago, it was typical on like more consumer tech side, or and also SaaS, to raise money and spend a lot of it on marketing or Facebook or Google ads. Like that wasn't acceptable. And I guess there's like some percentage that sometimes it was like 30 to 45% of a seed round would be spent on that to accelerate user growth. I think now the like the ability to keep your CAC down, or have strategies to reach users in ways that are not dependent on ads and using up marketing dollars is really important. Being thrifty in that way, and of course, increasing like, yeah, revenue per customer. But really, I think if you're thinking about something like really early stage, as you're acquiring users, trying to figure out strategies to keep your CAC down. And so when you're talking to an angel or VC, you won't be like, oh, we're using this round, like 30-40% for marketing for user growth. Cause that's like, yeah, it's not kind of like a unique go-to-market strategy for a startup.
So how many months should a startup grow to prove the metric that like we grow 50% month to month or 100% month to month? Like 2 is enough, 6 is okay. Because a lot of founders, they see the initial growth and they see a good trend and they come to investors and they say like, okay, these are good numbers. Let's see how you will do in 3 months or in 6 months. Melinda, to your opinion, like how long should it take?
Yeah, I think, I know from the founder perspective, I would say at least 3 months, because then it wouldn't be, kind of an anomaly. Of course, like 6 months and then 12 months is like ideal. And I also know it can be challenging because some investors like definitely say like we prefer to like get to know the founder even before they're ready to like raise, versus other people that especially advise startups say like you should have like a process when you're raising where you're really only talking to investors for like a month, not necessarily to like create like FOMO, but like just so that it doesn't take up a lot of your time. So that can be challenging because you don't know whether to reach out earlier where you might not have as much traction, but it's good to build the relationship versus, like really being ready with your metrics. So, but I would say at least 3 months, because then that that's not an anomaly. Like, and then of course, if you say 1 or 2 months, like it was going up and you happen to have another month where it was like the same or slightly lower, then someone could take that trend like further and say that it's going down, even if it's like, the same or pretty good.
Thank you. Rich, do you agree 3 months of sustainable growth?
I think it depends on your audience, on who you're pitching to. I think 3 months is more than fine for an accelerator or an incubator program per se that you're looking at. I think if you're looking, and it also depends on like the macro environment that you're kind of playing in. In terms of what it is, I think you should, to what Melissa said, like you should be building the relationship as soon as possible. And from that, you can start to like, it's just easier to approach somebody and give people updates as you are growing, as opposed to saying like, I'm raising now, here's my metrics, like, let me raise, like, give me some money now. Obviously there's enough emerging managers that are out there that now you can start to maybe make that work for you. But ultimately I'm like of the school of like building a relationship at the earliest stage, because at the end of the day, like whoever you are giving a piece of your company to, like they're forever on your cap table. And so you really want to get to know them as well. I mean, yeah, we're talking from the perspective of the relationship of the VC investing into you, but at the same time, like you have to trust the VC because you're going on the journey with them too. So I think you need to that's something to keep in mind, just getting to know who you're partnering with. And then beyond, in terms of like traction, I mean, I think 3 months is good. Even better is obviously 6, but it just eliminates all things because it depends on what the business is. Like if you are in a particular industry where there's seasonality, that might be known. And so as a result, you're going to have spiking numbers in a particular season. So 6 months is even better than 3, but like you could probably start the raising process at 3 for sure.
How many times did you say to startups, you're too early for us? What is the account?
I mean, I think the number is obviously quite high because there's a ton of people that are pitching at all different stages. But I think for us, we're looking for like really post MVP right, in regards to where they are. And so sometimes people will come to us like during the building of the MVP or pre-MVP. And that's usually going to be too early for us generally. We are an emerging fund, so for us, every bet that we make has to be a calculated bet. And so as a result, we're looking for things that are able to go to market fairly quickly. So the number for us just tends to be a little bit higher, in regards to it being too early in that case.
Thank you. My next question is, to your opinion, what metric is absolutely irrelevant for early stage? What we can just put off for better times and founders just don't break their minds on that metrics. They will be important later, maybe. LTV, any other metric that we can just forget when building on early stages? Melinda. I think you're muted again.
Yeah. I don't know. I think I'm probably a little more sympathetic than some people because I'm a founder myself. So, but I guess some people say, some investors really say that like advisory board doesn't matter. I mean, it can only help. I guess that's more a strategy also from a founder perspective, like giving up shares or that. But I guess some investors say of all things going on, that's probably least important to work on. On the other hand, of course, the reason why you connect with people is to for their guidance, but also for their network. So of all the, I think that's probably the also, I guess, separate from like a metric, but I think having like a full 5-year like revenue projection is probably not helpful in the early pre-seed seed stage, just because there are so many unknowns. I mean, I guess some investors like it because even though they know it's wrong, then they want to see your logic and rationale on it. But right, I mean, it's really hard when you're pre-seed seed to predict that far in advance.
Thank you. Rish, what's your opinion about this? What you can just put aside easily?
Yeah, so for me, I'm actually one of those investors that likes to see the five-year projection.
Okay.
Personally, I just think, yeah, you do get the rationale and the logic, and it really makes me understand as the investor what you are seeing as your growth levers, like where you're putting your money, how you're actually allocating. It gives me at least some sense of how you are going to be an allocator, because as your founder, you are not only like the operations and running the business, you're also a capital allocator, right? And I need to know how you're going to allocate capital within the organization. And so it gives me some insight on it. Obviously, it's never going to be perfect. Tons of variables occur, but we need to get some sort of understanding of who you are and your rationale behind things. And then in terms of metrics, I mean, at the earliest stages, I really not a fan of LTV. Like, I don't think it really matters in the earliest stages. By the time you hit seed, at a pre-seed level, like you're probably pivoted several times already, and that's going to dramatically affect your LTV. And so that's probably on a pre-seed level. LTV is probably not interesting to me per se. And then in regards to, I think the other thing that in seed stage, we're looking for all the basic metrics that you're going to look for anything traction, because by seed, you should be hitting product market fit. You might not be 100% there, but you should be a large majority of the way there. And you should be just raising money to kind of put gas in the engine to scale it. And so that's kind of, we're looking for more of the basic numbers there. And so, yeah, and then I would say to Melissa's point, it really depends on the type of business that you have and the expertise and the background of the founder, whether the advisory board matters or not. I think in most cases, in most industries, it's not going to make as much of a difference, but there are certain things like life sciences, deep tech, maybe some artificial intelligence on an infrastructure level, where that type of advisory board actually could be incredibly helpful. But yeah, it's kind of a case by case basis in the case.
Awesome. So let's talk about pivoting, because when a startup pivots, then half of the metrics become irrelevant. Because if you change the product, maybe the audience changed or the services, then you start over. Let's say I started a company 4 months ago and then I pivoted once and then pivoted another time. And so I have this chaotic batch of metrics, and they are like for different products or for different parts of the product or different services. What would be the best strategy for me when pitching investors? Just forget about the previous phase of a startup and start over with the new qualities after the pivot, or say openly, like, this is what we tried, this is our hypothesis that we tested, we failed here but we succeeded here, and here is like our new traction, and it's only like a couple of weeks. So do we need another 6 months to prove that the pivot was a good decision? Melinda, what do you think?
Yeah, I mean, I guess ideally, yes, but also if you already had the meeting scheduled and stuff, or are meeting people, then understanding the reasons for the pivot and what lessons were learned and how you're changing things can also be valuable. So, but you would, I don't know, I mean, obviously, ideally, you would want to have 6 months, like similar metrics, but I know it's like you don't want to run out of runway and stuff. So, um, maybe a shorter time frame would also be acceptable.
Thank you. Rish, what do you think?
Yeah, I think it's important to speak to kind of your pivots. So it's all part of the storytelling of what you're building and why you're building it and the backstory of the company. And so I think providing the context in regards to the pivot is actually quite important. And I think in your metrics and in your projections or whatever data that you are sharing to investors, you can put a delineation mark in terms of like when the pivot occurred, and kind of and in conversation we'll discuss the learnings and why you made the pivot and appropriately. And so I think that's all good, but I think you do need to keep like at least 3 months of data that's post pivot, showing that the traction is kind of moving in the right direction and substantially increased in terms of the month over month growth or other metrics to what it was previously to the pivot. So
I heard several VCs said that pivots like marriages, like you don't want to startups with too many pivots, or you don't want to partner with too many marriages. So how many is too many, to your opinion? Like if a startup pivoted 5 times, is it okay?
yeah, I think that's probably an excessive amount. But I mean, I think to me, I like to say like it's kind of very a personal decision, right? It's a very personal decision to you and your co-founders in the business in regards to how many times you're going to approach a problem. I mean, there's going to be examples that are out there in startup lore that they pivoted 6 times and then they eventually found it, right? Like,
Figma
yeah,
pivoted 7 times in
yeah.
7 years.
You're going to see the examples of people that are going to go after markets and it's going to work out after multiple. To me, I'm very precious in regards to time as a person, and so I really like to hold that. So it's like to me, it's like I give it 3 strikes and out type of thing. That's usually the approach that I would take. And the advice that I give is like pivot 3 times. If you can't get something that's kind of blowing up, then like maybe you're not closing the startup, but you're maybe addressing a different market. And then I would consider that you're launching a new startup, as opposed to kind of a pivot within an existing market that you're approaching.
Thank you. So now let's talk about revenue. pre-revenue, first revenue?
Oh, I just wanted to add something regarding the pivots. If a startup or a company is able to do that many and sustain, well, yeah, I guess according to the IRS, if they haven't made any money for like 5 years, then it's kind of actually considered a hobby rather than a business if it was set up as an LLC. But um it seems like if they were able to sustain that long, then it might be a business rather than a startup, which is fine, which is means like they probably wouldn't necessarily even need to raise capital. I mean, as we know, there are a lot of big examples that of startups that like really pivoted from their main start, but of course they had like funding and runway to do that. So I guess it's the context, but you probably wouldn't be like pre-seed or seed if you had had that much time to pivot 3 or 5 times.
Thank you. Thank you so much. And let's start about revenue. We hear this word a lot as startup founders, like all investors wants to look at the revenue growth. What if you have all other metrics like user growth and what is enough like pre-revenue, and some startups prefer to test their ideas for free and see if there is a demand in those services, and then they start charging and the situation changes. So how early a startup should start charging for its services, what it depends on, and how to manage the expectations of investors regarding revenue? Let's start with Rish.
Yeah, so I think this is one of those questions where it really depends on the business model that you have. It's a real big thing. Like if you're in a marketplace, you're probably going to charge substantially later than you are in a SaaS tool to a consumer tool of some sort. So I think it really depends on what business model you're going after and what market you're going after. It's going to make a big difference in terms of when you're going to charge appropriately. But if you are, I'm just thinking, bring it back to SaaS, because SaaS tends to be the most common business model that people are racing against. My thinking is always in a B2B SaaS environment is to do a few pilots to validate the product, get customer requirements, kind of all that stuff. But like you should be trying to validate pricing and monetization as soon as possible, because you're never going to really know like if this is truly scalable unless you start charging. You're not going to know true customer validation. You're just going to know kind of product requirements and what people like, but not really what they're willing to pay for. And so I think the sooner you can get past the stage of just validating and building out the product and get straight into monetization, the more likely you're going to see like whether the growth you experience pre monetization is actually valid or not.
Thank you, Melinda. What do you think?
I think, yeah, definitely I agree with that. And I also think in general, the era of like trying to, or like using money to raising money to get to 10,000 or 100,000 users and then monetize on a consumer side and then monetizing is not really like, given the market these days, is not really yeah, I wouldn't, I mean, obviously there are caveats, but in general, that kind of model where you are using the venture money to get network effects before you can do it on your own is not really accepted these days. And then yeah, and then as he was saying on the B2B side, yeah, I mean, I know on the like indie kind of hacker side, like a lot of those guys, like they just like make a SaaS or whatever very quickly and then test like $5-10, from the start, test pricing to see how many users they can do, rather than and never have the plan to raise money. But so anyway, I guess my point is like a lot of entrepreneurs are like testing pricing very early. So, yeah,
Earlier
that
the
should be earlier the better. Yep.
Okay, so start charging from the start. Thank you. And there is a question in the chat about gross margin. That's actually a great question, because is it important at early stages, or if there is like any revenue and it's growing, you can fix things later when you fine tune your model, when you already have customers that are sort of satisfied with your product and happy to pay. Rish, what do you think?
Yeah, I think you need to be aware of gross margin as soon as possible. The reason is, not saying that you're not going to improve gross margin or through scale or other means of operations, but it's generally going to know where your bandwidth of how much you can expand it, versus like, you're not going to be able to take something that's like 15% gross margin to 70% in a traditional like SaaS model that people are looking for. So it's just like establishing where your benchmark is today, and understanding where you need to get to go to match kind of industry standard of the top quartile is raising at. I think it's important to be cognizant as soon as possible. It's not going to be necessarily where you're ending at. It's just a benchmark and a point in time of an indicator of where you are today and where you need to get to. So that's the way I would look at it.
And what are the good ranges? Like, what are the alarming numbers, or something that you feel comfortable about?
Yeah, I mean, I think you're looking roughly to get like, you want at least 3x your like LTV to CAC in the case. So whatever that would look like. You're looking for, revenue between like, or gross margin between like 60% to 80% in terms of gross margin on a SaaS solution. On other solutions, it may be different. So like if you're doing something a little bit more like where it's more cost indicative, it may be 30 to 60%. It just depends on the sector. But generally what you're looking for is a healthy gross margin, and that benchmarks against where industry standard is in a particular category, or at least top, and hopefully top quartile.
Thank you, Melinda.
Yeah, no, I agree. I mean, definitely for like SaaS or tech-enabled companies, expect them to have like 70 or 80% margins, right? There's not a lot of hardware. And then there's this whole thing with the AI startups, being able to generate a lot of revenue per employee, but also depending on the AI startup, like how much compute and like hardware you need. But yeah, for SaaS or like consumer tech, yeah, expect high margins, and of course, yeah, with the potential to increase those margins with scale.
Thank
Because there
you.
really shouldn't be too much investment after making the product.
Right. Just a couple of questions and we'll wrap up the official part. So when you make a decision, you have founder's background, their character traits, their vibe, their persistence, all the things that you evaluate personally, and then the set of metrics that you just analyze on a very rational level. What is more important, Rish, for you?
It depends on the stage more than any, like that's a big factor in terms of where you're indexing. But I guess the things that are most important to me beyond, obviously, metrics are important as well, but the biggest thing for us at the earliest stages is team, market size, and then like a thoughtful execution to go to market. Like that's the big things. So are they going after a problem in a novel and effective manner? Is the market large? And does the team have some sort of competitive edge in the market that they're going after? It doesn't mean that they have domain expertise, but they have something appropriately that they can bring that makes them like different than anybody else that's going after that particular market.
Do you say that if you really believe in the team and you really like the founders and the metrics are like so or average, that your investment and your involvement can help them improve the metrics.
Yeah, so that's why I
Raise
said,
capital on later stages from other VCs.
yeah, so I think it's a two off question. So like, I mentioned before in my previous answer, like benchmarking. So if you're benchmarking like against average, but you're not top quartile, that's where if we were to come in like and help appropriately, we could offer maybe some operational support to help you push you up and get you to that top quartile and help you to then go raise additional rounds. But if you're like lower quartile to bring you up to average, like there's nothing we can do. As much as we love you guys as a founding, like it's going to be very difficult for you to raise appropriately. As somebody who comes from the operating and the founding side as a background, like I know I can add additional value and push things, but the truth of the matter is most VCs that you're working with are not founders. Have not been operators. So they're looking at this purely from a financial basis on where things are at the current moment. And so you need to kind of make a compelling case to those individuals that like they don't really need additional help for you to raise the additional capital.
There
So
are
I think,
some limitations that we can just
yeah,
spot in the numbers.
that's just like the reality of the circumstance. You can get a few people, whether it be a Melinda or somebody else appropriately that has an operational background that might be able to help you to get from middle of the road to top quartile, but you're not going to get anybody that can make discernible value to push you from lower quartile to top quartile. Like that jump is very rare, very rare.
Melinda, do you agree?
Oh, yeah, no, I agree. Yeah, I mean, but you also see, a lot of the accelerators, like, also, yeah, it's, mostly focused on team. And then sometimes you see them and the startup seems like really weird, but they're just betting on them because they like the team. And maybe it's not this idea, but it's like incubating a startup. So, yeah, that's something that happens in early stage investing too. I agree with him. And then when he was saying something, I think, yeah, the market, I think Tam and Sam and Sam is important because like a lot of people say, and like I'm saying, it's fine to have a business, but like obviously venture scale is different, and you can't like count like looking at like Fang or whatever and say, oh, if I have 1 billion users, like this will be a big business. Like ideally, right? Well, definitely on SaaS, like in the thousands of users makes it a venture scale business, and then consumer side, well, depending on what it is, like tens of thousands or hundreds of thousands. You can't say, well, if we become like have 1 billion users, like that is work. And yeah, and having a business like that's very successful is also good.
It's just we all want a very successful business. So the last questions is a little step aside from the product metrics that we discussed today, but the question, it pops up a lot in the conversations on the pre-seed round, on the really early stages. What percentage of the money raised a startup can allocate on marketing? And we heard different ideas about how investors consider marketing spendings, and a lot of them expect organic growth or just the founder-driven sales or something like that. So what is your opinion about marketing spending at early stages, not for product development, not for hiring, but for basically like user acquisition? Rish, what do you think?
And I'm gonna kind of, this is gonna be again bringing it back to this point. It really depends on the type of business that you are and the market you're going after. A consumer business, in terms of what you're going to spend on marketing, is going to be completely different than what you're going to spend on B2B.
Let's narrow a little bit, like for a SaaS startup.
Yeah, so like if I take it to SaaS, I mean, what I'm looking for is max capping it out at 30%. That's like the max I would want to be spending in the early stages on that. because like the main thing is and especially today, where most SaaS companies are going PLG, and so product led growth, and so like that tends to be where people are driving a lot more value than traditional marketing channels, or using traditional marketing channels to drive that growth. And so I'd say like 30% is where I'd cap it at on a B2B SaaS perspective. On a traditional or consumer SaaS play or an app, you're maybe looking at a little bit higher, so like 40-45% potentially. But I gotta understand the rationale and the performance on that ad spend too. So
we're talking
Yeah.
about pre-seed.
And to add on, yeah, obviously lower is better, and also having unique strategies, like I mentioned, rather than just buying like Instagram ads or Google ads is also important, that to reach your desired user and customer. And then, innovative or creative ways that are unique to your industry and your business are important. And I've also heard a lot, more so on the B2B side also, that really you shouldn't hire any like definitely not salespeople until it should be founder-led sales, up until like Series A, unless you're like a super high growth startup. But like typically, like most sales should be founder-led or founding team-led until like Series A. Like there's no reason to have like a sales team as part of your round. And also on the consumer side, I mean, not doesn't yeah, it doesn't have to be as founder led, but decreasing you shouldn't have like, I don't really think like, say we're hiring a marketing person like within a pre-seed, definitely not within a pre-seed round, but even within a small seed round, in a couple million, I don't think that um fractional kind of outsourcing kind of, or fractional maybe acceptable, but like saying we're using this round to build our whole marketing in an early stage is not really looked upon well.
Thank you. Thank you very much. And I suggest we go to the fun part. You have the feed of pitch cards in your House of Pitch account. And
Okay, like right now.
yeah, right now.
Oh, okay, cool.
So for our founders, this is how it works on the receiving side. Our investors, they have the feed of pitch cards. It works like Tinder, and they go through saying yes and no, swiping left and right. And let's start from Rish, and you can share your screen and comment while you're doing that.
can you see it?
Yep, we can see that.
All right, so this would be a pass, not because of anything else. It's just off thesis for us. So just keep that in mind. Again, off thesis for us. Well, this is not kind of relevant. It's more about deal flow, so I'll just pass on that.
I actually met with them there separately outside of House's Pitch. They have cool technology.
Yeah, so this would be
so I
one.
don't know if that pushes you, but they have pretty cool.
Yeah, I would meet with them just simply because one of my backgrounds is in some of the space that they were working in, so it could be a good fit there. And then here we would connect for kind of otherwise.
Also, yes.
Just not enough information in regards to what they're actually going after. So I would pass on this.
So for our founders, just be mindful about what you put in the pitch card, because investors only have a fraction of a second to decide if they want to connect.
Yes, that would be a no. Yeah, we don't do anything really crypto related, so yeah, fashion tech would be off thesis for us. Legal tech. Yeah, this is, yeah. Pass on that.
Physical artworks.
Yeah, I'm a bit confused on this, but yeah, I'll pass on this one. Okay, so this one would keep. He's kind of broken down things appropriately where he is. Differentiator, take a look at it. Pair the pitch at, if nothing else. Legal tech. Yeah. Okay. This might be interesting. So I'll take a look at that. Yeah, climate tech. What is he doing? Okay. Smart air quality. Okay. We'll connect with this. We do a bunch of IoT, as I mentioned. No code, video conferencing. Right. Yeah, this is just like an overly saturated market. So we will pass on this as a category. Property management, again, it's like a very saturated market. It's very hard to see kind of breaking out in this fragmented space. But he did say insurance broking, and he did say this. We do a lot of insurance tech deals. So I actually, after looking at this a second time, connect to see if
Good
there's
thing you had to explain it, because that gave you for him, because that gave you another 5 seconds and you changed your mind.
Yeah.
Yeah, that's awesome actually to see it in real life. That's amazing.
Yeah, this is a wrapper. We're not really a fan of wrappers for GPTs, so pass on that. I think she already submitted, so this is a second of the same one. So I'm gonna pass on that. Okay, what else is there? Yeah, this is, yeah, there's a lot of people going after this category. I wouldn't necessarily look at it per se for us. Yeah, we'd be off. This is off thesis for us. I'm pretty confused in exactly what they're doing. So since the pitch isn't really clearly telling me what exactly they're doing, I'm gonna pass. Yeah, I'd pass on this as well.
You have a lot of cards.
That's good. That's good for
Yeah.
this session.
Like I mentioned, we don't do crypto, so pass. So now I'm done.
All right, you went through all your feed. Congratulations. And I believe it's very valuable for our founders to see how you react. And now, Melinda, what's in your feed?
Yeah, I think it's a good idea. I'm not sure if well, obviously the size of the round is not the appropriate for VC. So, yeah, there might be other ways to meet, like an angel investor. I know there's probably angels on here, but as you can tell, like the size of the round, I mean, it has to probably be planned out, I guess, these days, right, for 18 or 24 months, but also like 250,000 at least, or 500,000. So I would say no based on that, but mm, personally, yeah, I don't, it seems like it's probably trying to do too much in one. And um if I yeah, if I think about it, then perhaps like this might appeal to like smaller startups, but then smaller companies, but then that's kind of like a tough customer base. Most of the firms that most of them, they primarily, well, they invest in, I guess Level Up and Allied Venture Partners, and a few of them primarily invest in US and Canadian companies, but then other ones that I work with do invest internationally. I already met with him. I know him, so I don't know why that came up. I mean, um, oh yeah, yeah, this sounds kind of cool. I've seen, well, definitely on the healthcare and biology side, seen people do AI twins. But yeah, I guess the idea of like avatars, like mimicking human customers is interesting. Mm, I think I already met with this before.
It's
I
been
also
a
I
while.
also met
You
with this
see a
startup.
lot of
I guess I meet
startups.
with every stage startup in the world because I've also
Yeah, you know them all. Yeah.
met with this guy Sampreet before. Um, mm, I think I saw something like this before. Um, yeah, I guess. I mean, I guess obviously there could be more than one startup in this space. I guess I would talk to them. Well, I know it was a trend on, I forgot what the name of that website was, but on Twitter like a couple months ago where people were like, I don't know, betting on a marketplace on different people. So I guess I'll talk to him.
No, that's actually a hot market.
Yeah, definitely it's a hot
Production.
market.
It's like
It's a hot
Sam
market, but
Altman
also
sends his regards.
yeah, like I know a lot of people trying to work on this and like, well, obviously there's Nvidia and all that. But on the startup space side doing it. Yeah, I guess maybe out of like academic interest and learning. I mean, I don't meet with people just to learn about an industry, but um like um I I think there it is a big market, so that's attractive and new technology. So I would meet with him and try to figure out. However, as you guys know, it's a very capital intensive um industry with, you know, like, you know, you probably have to raise at least 10 or 14 million to really get started. So that's a challenge. But oh yeah, this same guy as on the other one. I've met like a few startups in this space. I've already met with this guy before. I also met with this guy set before. I don't know if it was, that's like yeah, I consider that. Yeah, same with what he was saying, and plus, as you guys know, there's well, we're on Zoom and there's a lot of low cost Zoom video platforms themselves. Plus, so I'm um don't really see a lot of value in a company adding it to their own software. Oh, I will talk to her before. I wonder if these people just like don't remember me if they were like sending them on mine, which is hard to imagine. Same with what he was doing, and also, well, a lot of these things, like I said, as a founder, I know early stage startup entrepreneurs is like a really tough market, right? Because we're all trying to be like thrifty. Plus, a bunch of these can be, you can get some help with them, maybe not as personalized to what they fine tune their models, but with the generalized LLM. So it would have to be really different to for a user to get value from it and pay for it.
Awesome.
Okay.
Thank you.
Thanks.
Thank you very much for joining us today.
Oh, wow. Just right on time.
Right on time. The timing is perfect. Thank you for joining us, and follow each other on LinkedIn. If you have questions about House of Pitch, just drop us a line, and we're here to help. And we wish you all the success in the world and good luck raising funds. And thank you again, and have a nice day.
Thank you, everybody. Yeah. Looking forward
Thank
to
you.
connecting with you guys. Thanks.
Bye.
Thank you so much.